Being able to find great deals means nothing if you don't have the right team in place to execute them. And there are gurus who will tell you just find good deals and everything else will fall into place. You can handle everything yourself when starting out. Focus on getting deals first and build the team later. That's not entirely true. You know, in Jurassic Park, when they think they've got everything under control and then chaos happens? Well, that's us right now. Except I'm Jeff Goldblum and you're all the ones running from the T-Rex. Sorry to break the news to you. There are 3 crucial partnerships every investor needs if you want to scale your investment portfolio predictably without getting stuck with properties you can't sell or losing money on bad renovation. Investors who are scaling successfully aren't just the ones with the best deals, they're the ones who have built the right systems and teams. And in this video, I'm going to tell you which 3 partnerships you need in place before you even look at your first deal. Most new investors underestimate partnerships because they think they can do it all. Now, that was me in the early days. No mentor, no team, no clue about the importance of relationships. And when I first attempted to start my entrepreneurial journey with Airbnb, I went in completely alone, without any partner or relationships to guide me. And my Airbnb venture is where I lost $30,000. It was a painful lesson in the cost of going solo. It was during this failure, though, that I realized success requires more than effort. It requires partnerships. What is the true cost of going solo? Well, I learned this firsthand. Going solo is expensive, financially and emotionally. Burnout became a constant companion as I tried to navigate real estate without a solid network. In nursing, I had always relied on a team to save lives, and in real estate, I needed a team to make deals. This realization pushed me to seek guidance, and my turning point came when I surrounded myself with mentors and joined communities of investors. That's when everything began to change. How do partnerships change everything? Well, let me share with you. Partnerships multiply your impact. They give you access to expertise, networks, and support systems you simply cannot build alone. Just like in healthcare, where collaboration leads to better outcomes, in real estate, partnerships are essential for success. Relationships paved the way for my transition to private money lending after a 14-year nursing career. My partnership with Eric Fuller is proof. Together, we've closed deals that would have been impossible, including generating on one deal $389,000 in profit. It's partnerships that have transformed ambition into sustainable success. Now, what happens when you rush into relationship? Well, getting into a business partnership is very similar to dating or vetting your spouse. It's very rare that a speedy barroom proposal will result in a long-term marriage. Similarly, rushing into a business partnership without proper vetting can lead to disastrous outcomes. I've seen people lose tens of thousands because they didn't take the time to ensure that they're hitching their wagon to the right partner. I've seen people jump onto partnerships after hopping on just one Zoom meeting where everything seems perfect. Then down the road, one partner starts using business credit on their LLC to take their family on vacation, or takes more than their fair share of the profits, or completely stops performing their responsibility. It's incredibly important to vet your partner. Would you marry somebody after just one Zoom call? No, I know I wouldn't. So why would you jump into a business partnership without really getting to know the person? Take the time to align on values, responsibilities, and expectations before making final commitments. Misalignment is a recipe for disaster. This is why Eric and I spent 3 months basically vetting each other before partnering. We ultimately found that we aligned on values, goals, and strategies to ensure a strong foundation. So what makes a good partnership? I think it is clear communication, a proven track record, and ensuring that there is mutual benefit. In nursing, communication saves lives, and in real estate, it can save deals. Clear communication prevents misunderstandings and builds trust. It's a cornerstone of any good partnership. And so what is the importance of a proven track record? Can't we just figure things out together? Trust is earned through results. And when I joined Eric on deals, I saw his track record firsthand. This gave me confidence to partner with him and create a scalable business. So how do you ensure mutual benefit? Well, every partnership should be a win-win. Erica and I didn't just ask, what can I get out of this? We asked, how can we bring value to each other and to the people that we serve. Now, when you first start doing deals, you may not have a business partner right away, but there are 3 key partnerships you absolutely need to succeed. So let's start with the first one, a real estate agent. A great real estate agent is like a compass, and they can keep you on course. However, not all compasses point north. So the wrong agent could lead you into poor decisions and missed opportunity. To find an agent with real market expertise, you need to look for somebody who understands current market trends in their area. They should know the average days on market for properties, demonstrate a strong track record with listings to back that. That's sold in a timely manner, showing that they have a good command of the pricing that is expected in their market. I would ask them to provide a list of properties that they've sold along with the average days on market for each and compare that to the area's average. This will give you insight into their ability to price properties accurately and adapt to market demands. An agent with good comping skills is also essential. You need to look for signs that they understand the key rules of comping. Do they use recent comps, typically no older than 90 days? Are the comps from the same neighborhood or subdivision, avoiding major road divides? Do the properties have similar square footage and build styles? If they send you comps that ignore these basic principles, such as using outdated sales or properties way far outside of the comparable area, that's a red flag. A knowledgeable agent will follow these guidelines to ensure that they're making decisions based on accurate and relevant data. Finally, I would assess their selling strategy to ensure that they're successfully navigating deals similar to what you're pursuing. Pay attention to whether they're overly optimistic about the ARV, promising top dollar without solid evidence, or if they temper their expectations and back up their claims with sold comps. The right agent will justify their property value estimates with data, not just hope, ensuring that you're making well-informed decisions. The right real estate agent will prioritize your success over quick commissions, setting the stage for long-term growth. Once you have the right agent guiding you on market trends and comps, the next critical piece to scaling your business is funding. So let's talk about private money lenders and private money partners. Private money lenders are the backbone of scalable real estate business, and here's why. They provide flexibility and speed that traditional financing just can't offer. Unlike banks, private money lenders can fund deals quickly, which means you're able to seize opportunities before they slip away, and often at much deeper discounts. On top of that, their terms are often more flexible, allowing for creative deal structures that can align perfectly with your investment strategy. They're not just funding deals, they're giving you the tools to scale effectively. So you might be wondering, how can I find this? Finding private money lenders doesn't have to be super complicated. It all starts with networking. Real estate meetups and online communities like BiggerPockets or LinkedIn are great places to connect with potential lenders, but also don't overlook the people that are already in your life, friends, family, or colleagues who are looking to earn passive income. They could be interested in funding your deal. It's about starting the conversation and showing them the opportunity. But you also might be wondering, how do I build trust? Well, building trust with private money lenders is certainly key, and it starts with transparency and reliability. And when you approach a lender with a well-prepared deal package ready to go, you need to be including clear numbers, realistic projections, and detailed strategies to mitigate risk. But trust doesn't stop there. Keep the lines of communication open throughout the project. Be upfront about challenges that you will encounter and how you're addressing them. Lenders want to work with borrowers who deliver on their promises consistently and are being reliable and going a long way in building that trust. So what does a private money lender look for in a deal? Private money lenders are looking for a clear exit strategy. You need to show them how you plan to pay off the loan, whether it's through a sale or a refinance. They're also looking for a strong return on investment. They want to see that their investment will generate a solid return. Often they're going to be in the range of 12 to 18%, or if structured as a partnership, they may seek a 50-50 split of the profits. They're looking for competent operators. Demonstrate your experience, skills, or partnerships that ensure that you can execute the project effectively. If you are not experienced, they want to see that you're bringing in the right partner who has the experience to oversee the project. They want sound numbers as well. The deal should include conservative ARVs, reasonable rehab budgets, and appropriate margins for profit. So What are some of the common mistakes that you need to avoid? As a borrower, here are some common issues. Overpromising on return. Be realistic and conservative when presenting a return on investment to lenders. Inflated numbers erode trust. Make sure that you're not neglecting proper documentation. Always provide complete and accurate details about the deal, including comps, budgets, and exit strategies. If you're ignoring risk mitigation, that is also a problem. You need to show lenders how you have planned for contingencies, whether it's through reserve funds or alternative strategies. Failing to communicate regularly is also a huge problem. Keep lenders informed throughout the project, even when challenges arise. Make sure that you're not underestimating your numbers. Double check your calculations for ARV, rehab costs, timelines. Errors here can lead to losses and damaged relationships. You need to operate within reality. That's the key. I can't stress that enough. If you're pulling comps from all over the place to paint a rosy picture of your property's value, you are not doing you or your lender a favor. You're wasting time and money. Private money lenders typically look for sound numbers. The deal should include conservative ARVs, reasonable rehab budgets, and appropriate margins for profit. If this is resonating with you, hit that like button and subscribe. And stick around because I'm about to reveal one of the most critical partnerships of all. Now that you understand the importance of having reliable funding from private money lenders, let's turn our attention to the team that ensures your investment stays on track and doesn't crumble, literally. Your contractor and inspector team are the boots on the ground ensuring that your deals don't fall apart. When it comes to hiring a contractor, this is the area where investors often think they can save money by hiring cheap labor. Don't fall for this trap. It will cost you way more in the long run. You need a seasoned general contractor, especially when you're new. A good contractor will vet your rehab plans and provide accurate estimates that prevent unexpected costs and constant change orders throughout the project. As for the inspector, they're your safeguard against hidden issues that could derail your project or eat into your profits. A thorough inspector will identify critical problems with structural issues, plumbing or electrical concerns, HVAC problems, roofing damage, or mold. These are the kinds of problems that, if left unaddressed, will not only cost you a fortune, but could resurface when you try to sell the property, impeding your ability to close the deal. So how do they work together, contractor and inspector? The inspector's findings should directly influence your scope of work. If you skip this step and leave key issues unaddressed, they will come back to haunt you during the sale process, often costing you way more money. The inspector identifies problem areas and the contractor incorporates these into the rehab plan to ensure that they're addressed effectively and within budget. This collaboration ensures that your property is market ready and free of major red flags when it's time to sell. So how do I find reliable professionals? Well, start with the obvious. Do they have a Google listing with strong reviews? If not, be cautious and avoid recommendations like your wife's cousin's brother's uncle who inspects on the side. No, look for professionals that have an established reputation in your community and a history of good public reviews. Once you've identified potential contractors or inspectors, I would assess their communication skills. Do they follow up promptly? Do they keep their promises? Poor communication is a red flag. Also ask for references from recent clients and follow up with those references. Here's a few questions that I've included in my vetting. How good were they at communicating? Did they stay on budget? How many change orders did they need? And how were those handled? How did they address unexpected issues? A good contractor or inspector will have nothing to hide and will gladly provide this information. One major red flag to watch for is also a demand for a large upfront payment. For smaller renovations, a 50% deposit might be reasonable. I'm talking like $16,000 or less. For a major project, you should only expect to pay 10 to 20% upfront, with the remaining payments being divided into 2 to 3 progress-based draws. Always be wary of contractors who request full payment up front. This is a common pitfall that will lead to unfinished work and lost money. By taking the time to find the right contractor and inspector team, you're going to be setting yourself up for success and protect your investments from costly surprises. So these are the 3 essential partnerships you need to have in place, and you should 100% start building these relationships now before you miss out on great deals, or worse, lose money on bad ones. And if you like this video, then you'll love this video. The Ultimate Guide to Getting a Private Money Loan for Beginners by Eric Fuller, my partner, about how to structure deals with private money partners. And you can use everything that Eric shows you in the video on screen to get your first investment property funded. Click to watch it right now.